Hi Mortgage Heroes, I'm Andy, and this is Monday Mortgage Minute. Last week was mostly a dud when it came to the news, except for a few surprises. Number 1, national homebuilder sentiment, and number 2, core retail sales and retail sales. First, national homebuilder sentiment came in at 50, which marks its 5th month in a row of increase. Yep, it's been on the rise for the past 5 months. On one hand, this is a great reading because 50 is back to neutral on a scale of 0 to 100. On the other hand, it's still 50 and spent way too long in the trenches of the 30s and 40s, while mortgage rates got clobbered in the fall and the end of 2023. Builders are finally seeing that demand has returned as buyers and real estate professionals have all come to the conclusion in lockstep that the state of the market is the state of the market. And if you want to get a home still, you better get it there and start looking. The only thing that could make this even better is for next month's reading to be above 50, even if it's just by a little bit. As for core retail sales and retail sales, they're starting to show cracks as the US consumer pulls back on spending in a lot of categories that economists and analysts watch. This is also happening across all economic levels. Yes, even among the upper income earning households, spending is being curbed. This is interesting because the buyer resurgence in mortgage applications, open escrows of existing homes, and new builds suggest there is fuel in the tank when it comes to the appetite for homes. And that makes sense because we make conditional exceptions for basic human needs like food, clothing, shelter. But the real story here will be discretionary spending across industry and economic status. That's really the ember people have their eyes on, and is typically a leading indicator of overall economic trajectory when the sense of headwinds becomes a little more palpable. So what does that mean for mortgage rates, Andy? Mortgage rates will continue to march sideways like they have for weeks. It's become customary for rates to move up and down in a tight 0.25% price range when there's no major macro direction to attach to. Expect that will be the same this week. We're also tipping into the window where all eyes and ears begin to turn towards the upcoming Fed meeting Wednesday, June 14th. The markets are all grasping for any hints it can latch onto prior to the rate release and press conference. You will also begin seeing more predictions on whether there will be an additional rate hike, rate pause, change of tone, and descriptions of how the Fed members are feeling about their policies. Here's a quick look at what we're watching in the markets this week. Tuesday, we get flash manufacturing PMI and services PMI and new home sales. Wednesday, Federal Reserve meeting minutes will come out. There should be no surprises here, but if there are, watch out. Thursday, we get preliminary GDP, which has been a crapshoot as of late, and also unemployment comes out. There's a bit of controversy about this little GDP topic because there's a mostly unknown trend of reporting great numbers on the day they're supposed to be released, and then quietly issuing the revisions afterwards when almost no one's looking. Oh, and the revisions are terrible, by the way. They've been way worse than initially reported, but don't get mad at me for reading the numbers on a report. They're the ones fudging the figures, okay? Friday, core PCE, the Fed's favorite measurement for inflation. Personal income and personal spending also come out, all of which kind of mix together and paint a picture of how the consumer is doing when it comes to income versus spending. If anything has a chance at stirring up optimism or dashing people's hopes this week, Friday will be the day. And that's it for this episode. Let us know how we can help you win in mortgage and real estate. Remember to subscribe and check out the Mortgage Heroes podcast on your favorite podcast platform, YouTube, Apple, or Google. Thanks again for watching, and we'll see you again next week.